A $10 trillion Bitcoin sounds insane, until you realized Wall Street may already be positioning for exactly that. Anthony Scaramucci, one of the biggest institutional investors in crypto, just made a prediction that could completely change how investors think about Bitcoin. But here's what most headlines won't tell you. This prediction isn't based on hype. It isn't based on memes. And it isn't based on retail investors buying the dip. It's based on something much bigger. Quiet changes happening inside banks, pension funds, governments, and a financial system that's beginning to treat Bitcoin less like speculation and more like infrastructure. Today, we'll break down exactly why Scaramucci believes Bitcoin could become a $10 trillion asset, why most investors are looking at the wrong indicators, and the one catalyst that could accelerate everything much faster than almost anyone expects. A Wall Street financier who put 70% of his own net worth into one asset just said something that should be making headlines everywhere. It isn't. Anthony Scaramucci, the man who ran Skybridge Capital, who briefly stood behind the podium at the White House, who talks to hedge funds and family offices every single week, believes Bitcoin is on a path to a $21 trillion valuation. Not eventually, within this decade. Right now, Bitcoin sits nowhere close to that. And that gap is exactly why this matters. Because either the biggest names in finance are wrong about where money is going, or most people watching this video are about to miss the setup of a lifetime. Stay with me until minute 16, because what I'm about to show you connects three quiet developments that, together, change how you should be thinking about this entire asset class. Quick note before we go further, this video is for information and education only. Nothing here is financial advice, and nothing is a guarantee. Scaramucci has a financial stake in Bitcoin being right, and we'll talk about that honestly. Do your own research, talk to a licensed advisor, and never invest money you can't afford to lose. Now, let's get into it. Before we go deeper, tell me something. Morning, afternoon, or night for you right now? Drop it in the comments. I read everyone. And here's today's question, the one I want you to sit with as we go. What market cap do you think Bitcoin actually reaches? 5 trillion? 10 trillion? Or do you think Scaramucci's $21 trillion number is fantasy? If you're new here, this channel breaks down where smart money is actually moving, without the hype and without the doom. Subscribe if you want to stay ahead of what's coming, because what happens over the next few years is going to separate people who were early from people who were just watching. Let's establish something quickly, because this matters for everything that follows. Scaramucci isn't a crypto influencer chasing clicks. He built Skybridge Capital into a real institutional asset manager, the kind of firm that manages money for family offices, endowments, and high net worth individuals who don't have patience for hype. Before that, he spent years as a hedge fund manager on Wall Street, and for a brief, widely covered stretch, he served as White House communications director. He hosts a conference every year that pulls in some of the most influential names in finance, technology, and politics, which means he has a direct line into rooms most people never get access to. He sits across the table from hedge fund managers, sovereign wealth allocators, and family offices that move real, long-horizon money, not meme money chasing a weekend pump. When he talks about what institutions are doing, he isn't speculating from the outside. He's describing conversations he's actually having. He's also not a neutral voice, and it's important we say that plainly. He has publicly disclosed that a large majority of his personal wealth sits in Bitcoin, and he's continued buying through recent drawdowns rather than stepping away. That matters, and we'll come back to it later, because a rational viewer should always weigh conviction against self-interest. A man whose net worth depends heavily on Bitcoin succeeding has every incentive to keep telling that story. But here's why serious investors still listen anyway. When someone with real institutional access changes or sharpens his long-term thesis, it usually means he's seeing something in the plumbing of the financial system before it shows up in a headline. Retail investors read news. Institutional investors read flows. And flows tend to show up months, sometimes years, before the public narrative catches up. So the real question isn't, is Scaramucci right? It's, what is he actually seeing that's driving this specific number? Let's get into that. Here's where things start to get interesting. The number isn't random, and it isn't pulled from hype. It comes from simple math layered on top of a monetary argument. Bitcoin has a hard-coded maximum supply of 21 million coins. That number can never change. If each coin were eventually worth $1 million, the total market value of all Bitcoin would land at almost exactly $21 trillion. Where does $1 million per coin come from? Scaramucci's argument leans on gold. All the gold ever mined in human history is worth somewhere in the neighborhood of $20 to $50 trillion, depending on price assumptions. His case is that Bitcoin, as a scarcer, more portable, more verifiable form of the same idea, could eventually capture roughly half of that value as a competing store of wealth. Half of 50 trillion is 25 trillion. Half of 40 is 20. You can see how the $21 trillion figure sits right in that range, almost deliberately, matching the total coin count itself. But here's the part. Almost nobody explains clearly. This isn't a bet that Bitcoin becomes the future of daily payments, the way it was pitched back in 2013. It's a bet that Bitcoin becomes a permanent seat at the table next to gold, treasuries, and real estate, as a place large pools of capital go specifically to sit and preserve value across decades, not to transact with on a Tuesday afternoon. There's a second layer to the argument, too, one that gets less attention. Part of the case rests on generational change. As younger investors, the ones who grew up with Bitcoin as a normal part of the financial landscape, rather than a strange internet experiment, move into positions of real financial and political influence over the next 10 to 20 years, adoption patterns could shift in ways older models don't fully capture. Add to that the early conversations around artificial intelligence systems and autonomous agents potentially transacting in digital currency, and you start to see why some proponents think even 21 trillion could end up being the conservative estimate rather than the ambitious one. Why stop at 21 trillion, though? Some of the same people making this case genuinely believe it's conservative. We'll come back to exactly why later, once we've covered where the actual buying pressure is coming from. Now, here's the part nobody's paying attention to, and it's bigger than any single price target. For most of Bitcoin's history, the ownership pattern looked like this. Retail buyers, moving through exchanges, driven largely by speculation and headlines. That's the cycle most people still picture in their heads when they think about crypto. That cycle is not the cycle anymore. Today, the flow looks different. Spot ETFs sit at the center, pulling in capital from brokerage accounts that never touched a crypto exchange in their life. Public companies hold Bitcoin directly on their balance sheets as a treasury asset. Wealth management platforms are beginning to offer it inside diversified portfolios. And quietly, pension funds and endowments, the kinds of institutions that move in decades, not days, are running the early evaluations. This is exactly why this matters right now. When ownership shifts from short-term retail hands to long-term institutional hands, the entire behavior of the asset changes. Sharp, retail-driven panic selling becomes less dominant. Allocation decisions get made on quarterly and annual timelines instead of hourly ones. That doesn't mean the volatility disappears. It hasn't. Bitcoin has fallen roughly in half from its all-time high near $126,000 set in October of last year. And as of this recording, it's trading in the mid-$60,000 range, still searching for a durable bottom. But the buyers stepping in during this drawdown look structurally different than the buyers who stepped in during previous crashes. Previous cycles saw retail capitulation, panic selling, and forced liquidations dominate the bottoming process. This cycle, spot ETF flows and corporate treasury buying have continued through the drawdown rather than reversing sharply, which is exactly the kind of behavior institutional allocators point to, as evidence the ownership base has genuinely changed, not just the marketing around it. Comment below if you're already holding, watching from the sidelines, or completely new to this conversation. I want to see where this audience actually stands, because the answer tells me a lot about how early or late people feel right now. This is where smart money is already moving, and it's happening in places most retail investors never look. In April of this year, Morgan Stanley became the first major American commercial bank to launch its own spot Bitcoin ETF directly, trading under a new ticker on the NYSE. That's not a small development. That's one of the most conservative institutions in American finance, deciding it needed direct exposure infrastructure for its own clients. Behind the scenes, custody solutions have matured. Prime brokerage desks now handle digital assets alongside equities and bonds. Wealth advisors at major firms are being trained and licensed to discuss Bitcoin allocations with clients who ask. Tokenization, the process of representing real assets like funds and bonds on blockchain rails, is being piloted by firms that don't make small bets on gimmicks. None of this is built for a 6-month trade. Infrastructure like this takes years to plan, years to get through compliance and regulatory review, and years to unwind if a bank ever decided to walk away. When a conservative institution builds custody and settlement rails for an asset, it's making a quiet, expensive statement about where it expects demand to exist 10 years from now, not next quarter. Think about what it actually takes for a bank the size of Morgan Stanley to offer a product like this. Legal teams have to sign off. Risk committees have to model worst-case scenarios. Compliance frameworks have to satisfy regulators who, until recently, treated crypto with open suspicion. None of that happens on a whim, and none of it happens because a bank wants a headline for a quarter. It happens because the institution has concluded client demand justifies years of infrastructure investment. And this leads directly into the biggest misunderstanding retail investors still carry about this entire asset. Here's where things start to break down for the average investor watching a price chart. Retail thinking tends to move in a simple ladder. Bitcoin at $1,000 felt expensive, then $10,000 felt expensive, then $100,000 felt expensive. Each stop on that ladder feels like the ceiling, right up until it isn't. Institutions don't think in that ladder at all. When a pension fund or endowment evaluates Bitcoin, they're not asking, is $64,000 a high price? They're asking about total addressable market, liquidity depth, correlation to existing holdings, and what a very small allocation does to overall portfolio risk. Run the numbers with me for a second. If pension funds globally, which collectively manage tens of trillions of dollars, allocated even 1% of assets to Bitcoin, that single decision would represent demand many multiples larger than the entire current Bitcoin market, which sits around $1.3 trillion today. That's not a prediction that it will happen tomorrow. Most pension boards move slowly, and a full 1% allocation across the global pension system is still, realistically, years away if it happens at all. But it's a useful illustration of why institutional investors don't think in terms of, is the price high? And they think in terms of, what does a rounding error allocation from the world's largest pools of capital do to an asset with a fixed, unchangeable supply? This is also why the psychology trips up so many smart people. Someone who bought Bitcoin at $500 looks at $64,000 and assumes they missed the entire move. Someone evaluating it as a percentage of global reserve assets looks at the exact same number and sees an asset that has barely begun to capture the addressable market. Institutional allocators are now modeling. Are you positioned for that scenario? Or are you still evaluating Bitcoin the way you did back in 2017 when the entire conversation was about speculation rather than allocation? But this is where the story becomes almost mechanical. And it's exactly why that assumption about Bitcoin is already expensive falls apart. Roughly 20 million of the 21 million total coins have already been mined. Less than 5% of the total supply remains to enter circulation, and the rate of new issuance keeps shrinking through Bitcoin's built-in halving schedule. At the same time, demand-side pressure keeps stacking. Long-term holders, the people and institutions least likely to sell, control a large and growing share of the supply. ETFs continue absorbing coins into custody, often for years at a time. Corporate treasuries, led by companies like Strategy under Michael Saylor, continue adding to balance sheets even through drawdowns. Some governments are actively debating strategic reserves, and a meaningful percentage of the total supply is simply lost forever in wallets whose keys no one will ever recover. Shrinking new supply, growing long-term demand. That combination doesn't guarantee a price outcome, and it never should be treated as one, but it does create a structural squeeze that doesn't exist in most other asset classes. Gold miners can dig for more gold if demand rises. Governments can print more currency if they choose to. Bitcoin's issuance schedule cannot be altered by any single actor, institution, or government, no matter how much demand shows up. Here's the part almost everyone ignores. This dynamic doesn't require Bitcoin to become popular with new people to have an effect. It only requires the people who already hold it to keep holding, while a small, steady stream of new institutional buyers competes for a shrinking float of coins that are actually available to trade. That's a fundamentally different setup than an asset where supply can expand to meet demand. Stay with me here, because this is the piece that changes the entire valuation model if it plays out. Over the past year, the idea of national strategic Bitcoin reserves has moved from fringe conversation to something discussed openly in policy circles. The logic being floated isn't about replacing the dollar, it's about diversification, in the same way countries hold gold reserves as a hedge against currency and debt concerns. If even a handful of nations begin treating Bitcoin the way they treat gold reserves, competing quietly to hold a piece of a fixed 21 million coin supply, the buyer pool shifts from corporations and pensions to sovereign balance sheets. That is a different order of magnitude entirely. Do you think the system can hold as is, with debt levels rising and currencies under pressure globally? Or does an asset with a hard cap and no central issuer start to look less like speculation and more like insurance? This is exactly the argument Scaramucci and other long-term Bitcoin advocates keep coming back to. It's not that Bitcoin replaces money. It's that Bitcoin becomes one more seat at the table where nations and institutions park a portion of their reserves, the same way central banks have held gold for centuries without ever spending it at the grocery store. And there's a competitive angle here that rarely gets discussed openly. If one major economy begins building a strategic Bitcoin position, other nations face pressure to at least evaluate doing the same, purely to avoid being left out of an asset class with a permanently fixed supply. Nobody wants to be the country holding 0% of an asset that a rival nation is quietly accumulating. That dynamic, once it starts, tends to feed on itself. Now let's be honest, because a one-sided story isn't a useful story. There are real risks here, and credible people push back hard. U.S. market structure legislation for digital assets has stalled in the Senate for months, and continued regulatory uncertainty could slow institutional adoption significantly. A broader recession or liquidity crunch would hit Bitcoin, a still volatile asset, harder than it would hit safer holdings. Economists like Tony Annett have argued publicly that Bitcoin still fails the classic tests of money. It isn't widely used as a medium of exchange, it isn't a stable unit of account, and its store of value case remains unproven over a long enough horizon. Commentators like Peter Schiff have argued the entire trade has already run out of steam, pointing to Bitcoin's underperformance against both tech stocks and gold in recent months. And Scaramucci's own track record includes plenty of near-term calls that didn't play out cleanly. He's spoken publicly about needing further downside before a real bottom formed, and in past cycles, he's been early on rally calls that took longer to materialize than he initially expected. Being right about a decade-long thesis and being right about next quarter's price are two completely different skills, and even his admirers would admit he's better at the former than the latter. There's also a simpler risk that deserves mention. Bitcoin has existed for less than 2 decades. Every long-term thesis about it, bullish or bearish, is still an extrapolation from a very short track record compared to gold's multi-thousand-year history or government bonds' centuries of precedent. Extrapolation isn't proof. What happens next is the real story here, not any single prediction. Even people building this bullish case openly admit that the next 12 to 18 months could bring more pain, more regulatory delay, and more skepticism before the structural thesis has room to actually play out in the price. If this is starting to make sense to you, hit like, because it helps this kind of breakdown reach more people who need the full picture instead of just the headline. Here's the reframe that ties everything together. Bitcoin was never really competing with stocks. Comparing it to a growth stock was always the wrong lens. The comparison Scaramucci and other institutional allocators are actually making is against gold, against long-dated treasuries, against cash reserves losing value to inflation, against real estate, against the entire category of assets that exist purely to store wealth across decades rather than generate quarterly earnings. Viewed that way, the $21 trillion thesis isn't a claim that Bitcoin becomes the future of spending money. It's a claim that a meaningful slice of the tens of trillions of dollars currently sitting in gold, low-yield bonds, and idle reserves eventually migrates toward a scarcer, more portable alternative. That's a completely different bet than number go up. And it's why institutions are building custody, brokers are getting licensed, and banks are launching ETFs years before most of that capital ever actually moves. 5 years ago, $1 trillion Bitcoin sounded like a fantasy number thrown around by people who'd never managed real institutional capital. Today, a serious asset manager with decades on Wall Street is debating whether it reaches 21 trillion, and the biggest banks in the country are quietly building the rails to make that possible. The real question was never whether Bitcoin can technically reach that number. It's whether the world's largest pools of capital keep treating it as a permanent monetary asset rather than a passing trend. Because if pensions, corporations, and eventually governments keep moving in that direction, even slowly, the price tends to follow the capital, not the other way around. Scaramucci believes we're still early in that shift. Whether history proves him right is going to play out over the next several years, not the next few weeks. And that's exactly why this is worth tracking now instead of after the fact. If you've been watching channels like this for a while and this finally made the bigger picture click for you, do me a favor and drop the word Continuum in the comments. I'm tracking which topics to go deeper on next, and that word is my signal that this one landed. And tell me what you want broken down next. Gold versus Bitcoin as a reserve asset? What a 1% pension allocation would actually look like in dollar terms? Or the strategic reserve conversation happening in Washington right now? Drop your pick below. Are you positioned, or are you just watching? Share this with someone who needs to see the full picture before the headlines catch up to it. Subscribe if you want to stay ahead of where this capital is actually moving. I'll see you in the next one.